You know, something really strange is going on in the US economy right now. If you look past the day-to-day market noise, you'll see that a really fundamental piece of the economic engine, well, it's just broken. We're seeing this historic plunge in immigration, and it's creating a worker shortage so severe that it could push the entire country into a trap that's incredibly hard to get out of. So let's dive in and break down what is actually happening.
And hey, don't just take my word for it, a strange balance. That's a direct quote from the head of the U.S. Federal Reserve, Jerome Powell, talking about the American labor market. You know, when arguably the most powerful person in global finance starts using words like strange to describe the economy, yeah, it's probably a good time for us all to start paying very close attention.
So, what's the deal? What on earth is so strange about the economy right now? Well, that's exactly what we're here to figure out. We're going to connect the dots for you and show you exactly what's happening behind the curtain.
Okay, so the heart of this entire mystery really boils down to one massive shock to the system. And that is, the number of immigrant workers coming into the U.S. has, well, it's basically started to vanish.
I mean, just look at these numbers. It's staggering. Data from the San Francisco Fed shows that after we hit a peak of 3.3 million in 2023, net immigration is projected to completely collapse to just 1 million by 2025. Let that sink in. That's a 70% drop in the supply of new workers in just 2 years. That is a massive, massive change.
And look, this isn't some random economic fluke. This didn't just happen by accident. The Dallas Fed points the finger squarely at new government policies. We're talking about new asylum restrictions and much tougher enforcement that are, for all intents and purposes, just turning off the tap of new workers.
All right, to really get why this is such a big deal, we need to talk about a concept called break-even employment. Now, the best way to think about it is like the economy's metabolism, right? It's the bare minimum number of jobs the economy has to create every single month just to keep the unemployment rate stable as new people enter the workforce.
And this is where it gets crazy. With far fewer workers coming in, the economy's metabolism has just slowed to an absolute crawl. The Dallas Fed found that back in 2023, we needed to create about 250,000 new jobs a month just to break even. By the middle of 2025, we'll only need around 30,000. That's an 88% collapse. I mean, think about that. An 88% drop in the number of jobs we need just to stay in the same place.
So, okay, the labor supply is shrinking fast. The big question is, what happens next? Well, this is where we start to see the creeping shadow of a word that makes economists and pretty much everyone absolutely shudder: stagflation.
This right here brings us back to that strange balance Powell was talking about. Job growth has recently been averaging only about 35,000 a month. Now, normally, a number that low would be a 5-alarm fire, sirens blaring, screaming recession. But today, because so few new workers are even available, that tiny number is just just enough to tread water. And that's the really strange part.
But hold on, because some top officials think the real situation is actually even worse. Fed Governor Chris Waller came out and said he thinks job growth was, and I quote, probably negative. What he's saying is that the official numbers we're seeing are probably lagging and that the economy might already be shrinking. That's a pretty big deal.
So you've got this combination of really weak growth, or maybe even negative growth, and prices that just won't come down. That, my friends, is the classic textbook recipe for stagflation. And it is such a toxic mix because the normal playbook doesn't work. The tools you'd use to fight one problem, like cutting interest rates to spur growth, usually make the other problem, inflation, a whole lot worse. You're stuck.
And the logic for how we get there is actually pretty simple. It's like a chain reaction. Step 1. You have fewer workers available. That means companies have to fight over them, so they have to pay more to attract and keep staff. Step 2, to cover those higher wage bills, businesses have to raise the prices of their goods and services. And step 3, well, that's inflation hitting all of us in the wallet.
And listen, this isn't just some abstract theory. We're getting concrete warnings. Mark Sandy, who's the chief economist in Moody's, is saying that if these labor shortages stick around, inflation could spike from its current 2.5% all the way up to nearly 4% by early 2026. That would wipe out any progress we've made.
Okay, so let's bring this down from the 30,000-foot view of economic theory and see how this is actually playing out on the ground, in the real world. We're talking about everything from the farms that grow our food to the prices you and I are paying at the grocery store.
And this is where things get genuinely alarming. An internal memo
from the administration's own Labor Department warns of a, quote, sufficient risk of supply shock-induced food shortages. Just let that phrase sink in for a second. Food shortages. This is the government admitting internally that these policies could actually lead to problems with our food supply.
And the impact is hitting two areas that absolutely everyone cares about: food and housing. That very same memo warns that just a 10% drop in farm labor could slash fruit and vegetable production by more than 4%. And what about housing? Well, in construction, the ongoing worker shortage is already adding an average of $2,600 to the price of every single new home being built.
What all of this is creating is really a tale of two different economies, a real polarization. For, say, the top 10% of earners, the folks who own most of the assets and stocks, things are actually pretty good. But for basically everyone else, the story is grim. Savings are hitting historic lows. And for the first time ever recorded, spending by the middle class is now actually higher than their income. That means people are literally burning through their savings just to keep their heads above water.
So, here we are at a really critical turning point, a fork in the road. The question is all this just a temporary, painful adjustment that leads to a better, more productive economy? Or is this the beginning of a chronic, long-term structural problem? Let's take a look at the two competing ideas for what happens next. Now, I know what a lot of you are probably thinking, but wait, what about AI? Won't AI just solve all of this? And that's a fair question. But the reality on the ground is that adoption is just really slow. A recent analysis from JP Morgan found that as we sit here in mid-2025, less than 10% of companies are regularly using AI in their business. It's just not the silver bullet, not the quick fix for the massive worker shortage we have right now.
And that leads us to two very, very different potential futures. Hypothesis number one, the optimistic take, is that this is all just a painful but necessary transition to a new equilibrium, one where a smaller workforce becomes way more productive, supercharged by AI. But then there's hypothesis number two, the pessimistic view, that we are actually entering a period of structural stagflation, a really unhealthy balance where both the supply of labor and the demand from consumers are shrinking at the same time. And unfortunately, based on the data we're seeing today, there's a lot more evidence pointing toward that second, riskier path.
And so, we're left with this one huge question. For the first time in a very long time, the U.S. economy is facing a crisis that it basically created for itself. It made a choice, and it turned off the supply of workers. The challenge now, the monumental challenge, is whether it can figure out a way to turn that supply back on, or maybe invent a whole new kind of economic engine before this strange balance stops being strange and just becomes a permanent state of decline.
Look, the data here is pretty sobering, and the path forward is anything but clear. We are absolutely going to be keeping a close eye on this story as it unfolds. Thank you so much for watching. And hey, if you want to stay on top of the critical trends shaping our economy, make sure you subscribe.